we'll talk about the basic strategy. So we're looking at the out of the money butterfly, and we'll do that first. We'll start there. So I'm going to create a risk graph of what the out of the money butterfly looks like. Let's say that right here is at the money. So if this is at the money, then we want to put, say, a bullish fly on. And so we want to center it, say, right here, right? And so we push it out of the money. It will look something like this. Now let's say that our fly is 30 wide. That would mean that we would want to push it far enough in this direction so that the debit right here is no more than 10% of 30 or 3 or less. So that's our standard. That would produce a 1 to 9 risk to reward, right? That's what we're ultimately after. Here we are at the money, and what we really want is we want price to go in our direction. We want it to go this way. If it goes this way, then we're losers. If it goes this way, then we're potential winners. When we put this trade on, as soon as we put it on, there is a profit line that kind of looks like this, right? Where it will break even, and then here are various points of interest. Okay, so we put this trade on, and what we're hoping is that price will, again, go in this direction. Now, when would we put this trade on? We generally want to put these trades on in the morning between the open and maybe an hour after that. Let's say 10:30. That's approximately the ideal time to put one of these trades on. So if we get a trade on here and we achieve this kind of risk to reward, we're doing it with the expectation that price is going to move in our direction. Let's say it does, and it moves this way. And let's say that it gets to, let's see, what do we use? Let's use red. So let's say price gets to this point. Well, if it does, then we're going to have some level of profit here. Maybe as much as, I don't know, if this is $300, maybe $150, maybe $200, right? Well, that's pretty good. That's like 75% profit. You know, should we take that or not? Now, it depends on a couple of things. One is, what time of day is it? Is it the morning? Is it the afternoon? Or is it near the close? That'll make a difference. Of course, if it's near the close, I doubt that our profit curve will look like this, because during that entire day, that profit curve is slowly growing. You know, at one point it looks like this, and then at another point it looks like this, until it finally goes all the way up at expiration and fills up that butterfly at expiration. So that's another consideration that we have to make, because that profit curve is always growing, and that means that we need to keep on going this way or take profits at opportune times. Now, if we ended up, say, very early on, right next to the butterfly, say right there, and maybe early in the morning, say 11:30, we had a big move, it wouldn't be much for us to do. We could just sit there and hold on, because by just sitting there, our profit in the beginning might start off at 200, but by the time we get to maybe 2 o'clock, that profit might be $400 or $500. And we also still have the possibility of it moving into the profit tent where it could make substantially more, or it could go this way, right, and lose money. So you can see that there's a wide range of opportunities. Now, assuming that you're only 50-50 in terms of picking direction, then all of these profit opportunities are going to represent 50% of the opportunities. And so you're going to have to realize that only 50% of the time you're going to win, but 50% of the time you're going to be working on managing your profit. The other times you're going to let it go. Now, that's our most basic strategy.